Hey traders, welcome to this video. Today I want to talk about a typical market trend cycle. So from a beginning of a trend to the end or to a consolidation in a trend. And I think one of the best examples is this very strong bull market we are currently seeing in 2020. Especially in the tech stocks, so in the Nasdaq, but also in the S&P 500. And every strong up move in the market starts with a correction. And we had the correction here at the beginning of 2020, so a very strong correction, and it was very fast. And then we saw multiple rally attempts in the downtrend. Here's one, and of course here. And the first one failed, and then the market started to build a bottom, and we saw the first higher low. So this is here, this situation. So that's the first higher low. And also the first higher high, you can see it here. And this is really the situation when the market is getting interesting for me again. And when I look at the stock market, I do not look at the indices too much. I look at my watch list and I look at my screeners and I look what is coming up in the screeners and how is the quality of the setups on my watch list. I do that for a couple of years or for a lot of years, and I'm very experienced in analyzing charts and charts pattern, and I have a very good feeling for the quality of chart patterns. So I can see in my watch list and in my screeners if we have clear signs of leadership, if we have stocks which are showing outstanding relative strength to the indices, and if growth stocks, which is my niche, so my little trading niche, if they are leading or not. And I want to give you some examples of stocks which acted here in the first weeks or months of the rally. But if we before we come to that, I want to show you my interpretation of an uptrend. So, and especially in the first weeks of the uptrend, so something like 3 to 5 weeks, something a little bit, or sometimes a little bit more, sometimes a little bit less. This is the opportunity or the window of opportunity. This is really the time when you want to buy stock position and when the most stocks are breaking out from sound bases and from good consolidations. So this is really the time you don't want to miss, because otherwise you are missing the entry into very big leaders and very big stock market gains. And please do not see this as a fixed time range or something. This can vary from market to market or from market cycle to market cycle. It's mostly in the first weeks after we saw what William O'Neill called a follow-through day, or what I see here when I look at a higher low and then the indices rallied above the EMA 21. So then you really want to look at your watch list and your screeners, and you want to buy into the strong stocks. So this is really the window of opportunity. And then after that, of course, you see an uptrend. So, and this uptrend lasts from a few weeks to a few months. And in this phase, institutions are accumulating or finishing their positions. So, and this is really the time when the most stocks go up. But, and this is also something you want to recognize, a lot of stocks, especially the very fast leaders, so the early breakout stocks or the early movers, they start to consolidate and sometimes also to top in this phase. And that's why, especially at the end of the phase here, you want to be cautious buying new stocks. And the longer the trend goes up, the more likely it is that you do not find any good trading setups anymore. That's why you don't want to force trades, especially when the trend already rallied for some time. I did a lot of research about that, and I came up that the most uptrends last for something like 100 to 150 days. So the most strong uptrends. There are also weaker uptrends which last something like 50 to 60 days, but the really good bull markets last something like 100 to 150 days. And the more or the longer this period, and the more or the longer the rally, the less good setups you find, and the more stocks are or the more stocks can fail with breakouts. I show you that in a minute. And after this yellow phase, of course, there is something which I call the red phase, and this is really when the trend gets exhausted and when the trend is old. And you do not see an exhaustion run in every uptrend or in every bull market, but here you can see in the Nasdaq 100 that the Nasdaq 100 accelerated here in the last weeks, and this is also something which you cannot see in the indices alone. You want to look at the single stocks too. For example, in this red zone, a lot of stocks showed exhaustion runs, and also large cap stocks like Apple, Facebook, they all showed similar patterns, so blow off tops and exhaustion runs, and this is often the end of the market. And when you combine those informations from single stocks and the indices, you have a much better picture what's really going on in the market. So the window of opportunities in the first weeks when the market started a new uptrend, then the holding time when you want to hold your winning positions, but be very cautious to add new positions or breakouts the older the trend gets, and then the exhaustion phase when you want to sell your positions, sell your stocks when they show signs of exhaustions, and of course be very, very cautious or do not open any position in the exhaustion run. Okay, so let's go through some examples here. I prepared a short list. Of course, these are examples, so I selected them for educational purpose. This is not any recommendation for financial advisement, but I also selected them because they are a good example. So I saw those examples in hindsight. I think they are very good examples. And let's look at Docusign. You can see Docusign had the best chance or the best window of opportunity here in this range. So a little bit before the market shows a higher low. You can see here at the bottom the S&P 500, which moved similar to the Nasdaq 100. And you can see that you can buy, or you have a chance to bought Docusign here when they started to break out of this consolidation here. And that was after the market shows this higher low. You can see that here in April. And Docusign was one of the first stocks which broke out after the market gives you the signal that a new uptrend started. And that's when you want to buy into those stocks. And another one is LVGO, for example, which also had the opportunity or the window of opportunity here. You can see it was one of the first stocks which broke out to a new high from this IPO base, and it did it here in April when the market shows this higher low situation here. It was a little bit chasing here. I remember the situation very good. It was a little bit chasing here. But it was one of the first stocks which broke out to new highs and show very good relative strength. Fiverr, another big winner in this stock market uptrend, was a little bit late. So in the breakout here, you can see the window of opportunity was something like end of April. I think I bought it here on this 21st day. So end of April, so a little bit later, but it developed into a very big winner. And from my standpoint, it's also at the in the window of opportunity at the beginning of the trend in the stock market. So these are three examples of stocks which move into a new very strong trend together with the stock market. So you have the wind of the stock market on your back when you buy those stocks. I want to show you some other stocks here, like Octa, for example, which also moved into a new trend here with the stock market itself. But Octa very quickly turned into a consolidation. And what I want to show you is this failed breakout here. And this is very typical for stocks which start to consolidate early when the market is going up. You can see it here in the S&P 500. The market is still going up. Octa is going sideways. That means the relative strength from Octa in comparison to the S&P 500 is going down, and this is what you can see also in this indicator here. You can see the relative strength line is going down, and then Octa started a new breakout, and that was very late. It was in the exhaustion run of the general stock market or of the S&P 500 and Nasdaq, and almost any of those breakout attempts from stocks in a late stage of a uptrend of the general stock market or in an exhaustion run, they fail. So they break out, just run for a couple of hours in that case, or a couple of days, and then they failed when the stock market is turning down. Octa is one example. Datadog is another example, and this is not a failed breakout, but you can see that the stock is also going sideways while the stock market is going up. So the stock has a weak relative strength, or the relative strength is going down, and then of course every breakout attempt or every rally attempt failed here very quickly. You can see that here another breakout attempt, it failed. The stock built a lower high, and while the market is going up, and then of course it corrected more. Currently it's turning up and created a new base here, but you can see the weakness here of that stock, and this is something you want to avoid. You don't want to buy into a breakout or into sometimes also pullbacks when the market is already exhausted or in a late stage. Shopify, another example, where you can see here this failed breakout, very typical for late stage breakouts or late stage attempts to rally to new highs from stocks. And you can see that Shopify showed another pattern which I personally really like and try to avoid when I see that. I don't buy any new positions, and this is that every higher high gets sold. So every higher high of the stock was every higher high here showed a correction directly after the higher high. That means institutions or whoever is selling into the strength, and this is also a stock you want to avoid, especially when the market is exhausted and the trend is old. You don't want to buy breakouts in those type of stocks because they fail. I want to show you two examples of exhaustion runs, because especially in this fast and very strong market, we saw good examples for that. One is Tesla. Tesla had this very strong up move here over just a couple of days after they announced a stock split, and then they corrected directly after the stock split here. And this if you look into the chart here, you can see that this exhaustion run, or this very fast run, was exactly also with the absolute high here of the stock market. And this is very typical for leaders. They blow off. They use all the energy for the last move. So all the buying power is coming into the stock. There are no sellers left, or very little sellers left, and that leads to explosive stock price moves to the upside. And and then nobody is left here, only people who want to take profits and reduce their positions, and then the stock started to correct. That does not mean that Tesla will set up again and rally maybe to $1,000 or whatever, but in that case it's time to take some profits off the table, or to sell your stock position completely, because it can go down much deeper, as you can see, for example, in the last blow off top or exhaustion run from Tesla here at the beginning of 2020. Another example is Zoom, which is also a monster leader, or was a monster leader, and you can see the same thing here. So Zoom showed a blow off top here 1 day before the S&P 500 reached the peak level here, and then with a weakness in the market, Zoom started to correct and fill the gap, started to fill the gap. It was not filled completely, and now it rallied very weak, a little bit higher to the $400 level, and we will see if Zoom can set up again. I highly doubt that at the moment, but we will see that. And another example, also a big leader I already showed at the beginning, is Docusign. Very similar pattern. This is also 1 day with the earnings. Very high volumes coming into the stock, so at a typical pattern of an exhaustion run. Then you can see that Docusign also made a new high here, very close to this $300 level, so very close to this round number, and then got rejected on very high volume, then corrected on very high volume. So typical signs of exhaustion run. And the thing is, if you see this price action in a stock, this is not a sign of strength, because this uptrend already lasts for some time. You can see, so if you say, okay, this is the beginning of the uptrend, you can see it's 148 days, so around 150 days. So the stock rallied for a couple of months, and that means that a lot of institutions and a lot of buying power is already absorbed, and they already completed their positions, etc. So there is not so much gas left in the tank. And that's what you always want to have in your mind when you look at stocks which make explosive moves after they already doubled or tripled or whatever. This is not a sign of strength. It's mostly an exhaustion run. It's not always the case, but you must be very cautious if you see such behavior. And you must also be very cautious if you see such behavior in multiple stocks at the same time, because then you want to look again at the market indices and you can see, okay, they did the same thing, so they rallied very strongly for a couple of days and couple of weeks, and this is often a sign that it's getting, or the trend is coming to an end. So it is not, or it's not a sign that the stock market will crash or will correct strongly or something. Sometimes they can consolidate over time, but if you see such behavior in multiple stocks and also in the indices after the stock market rallied here for 150 days, you should be very cautious with your buying, and maybe think more about selling. So there was a lot of information in this video, and maybe you want to watch it another time. But let's sum it up. So always see the action in the indices, so price action in relation to the stocks. So have in mind that the window of opportunity is at the beginning of the trend and not in the middle or in the end. So it's really about buying the best stocks, the strong stock at the beginning of a new uptrend in the general market. Then letting your stocks run, so hold your stocks and be cautious with new buyings, the older the trend get, and then wait for signs of exhaustions in single stocks and in the stock market to take profits and to reduce your exposure, because after such a strong rally, often a correction or a consolidation will follow. So that's what you should know after you're watching this video. I hope that helped you, and you can follow me, of course, on Twitter, YouTube, Facebook, Instagram. But I recommend my free newsletter. I send it out every Sunday with trading tips and 3 stocks from my personal watch list.